If you think your mortgage is just a payment you make every month, you're missing the entire game, because the way your mortgage is set up will either quietly build your wealth or quietly drain it. And most Canadians don't realize which one they've chosen until it's far too late. Let's go. Most people treat their mortgage like a simple bill, something that they just have to pay, something that they try to minimize. We try the lowest rate, keep the payment manageable, and then move on. But that mindset is exactly why people stay financially stuck forever, because your mortgage, it's not just a payment, it's actually a financial tool. And if you don't use it properly, it's gonna work against you. There are 4 decisions inside of your mortgage that are gonna determine how your next 10 to 20 years play out for you financially. And almost nobody thinks about them properly or thoroughly. Let's start with the first one. How fast you're actually building ownership in that property. Most people think if I'm making my payment, I'm building equity. Technically, it's true, but here's what they don't realize. In the first few years, you're barely touching the balance of your mortgage. Let me explain to you what I mean. On a $700,000 mortgage, your first few years of payments are almost 100% interest, meaning you could pay tens of thousands of dollars, but barely move the needle. That's why some people feel like they've been paying their mortgage forever and still owe almost the same amount. It's not a feeling, it's how the system and the game are designed. So the real question, it's not, am I making my payments? It should be, am I doing anything to accelerate this? Because if you're not, you're just riding the default timeline. And the default timeline is slow and expensive. Now the second decision, how much control do I actually have? Most people think that they have some flexibility until they try to make a change. They try to refinance or access some equity to purchase something, or they try to break the mortgage early, and suddenly they realize they're locked in. I had a client who wanted to pull out equity to invest in a rental property. On paper, great opportunity, but their mortgage structure didn't allow it without a massive penalty being incurred. So they passed on that opportunity, not because it was a bad idea, but because their mortgage, it didn't allow for it and didn't give them options. That's what people don't see when they go after a low, shiny rate. The cost of not having flexibility. It's often bigger than the rate that you saved. Number 3, how does your mortgage react when life changes? Because trust me, life is always gonna change. I've been in this game for a while, and there's always something happening midterm. Never at renewal, always midterm. Income shifts, you have a kid, the job makes you move, unexpected expenses, and your mortgage, it's either gonna adapt with you or work against you. Let's say your payment is tight right now. Everything, it's manageable on paper, but then rates move or expenses increase. Now that same mortgage, it feels heavy. Not because it was wrong at that time, but because it wasn't built with flexibility in mind. And this is where people feel trapped. And it's not the house that they're in, it's the structure of the mortgage. Number 4, what happens when you try to exit? Nobody talks about the exit. Everyone focuses on that great feeling of buying a home, getting the mortgage. Nobody thinks about getting out of it. And here's the reality. Most people, I believe 6 out of 10, will break their mortgage at some point of their term, usually month 38. They move, they refinance, they restructure, and that's where the real cost is gonna show up. I've seen people save a small amount on their rate only to pay tens of thousands of dollars later just to get out. That's not saving money, that's delaying the cost, effectively kicking the can down the road. A quick reality check here. If you've never asked what happens if I need to change this mortgage, you're not choosing strategically, you're choosing blindly. Let's make this real for you. We have 2 homeowners, they both have the same income, they have same purchase price, same starting point. One chooses a basic mortgage, a low rate, minimal flexibility. The other chooses a slightly higher rate, but with options, prepayment, access to flexibility. And 5 years later, one has paid down more, has options, and can adjust. The other, it's stuck, limited, reactive, same market, same house, completely different experience. And the difference, it was never the rate. Let's talk about the process, because this is where people make the small, quiet mistakes. Step 1 is a full pre-approval. But most pre-approvals from, let's say, the bank, they're surface level, no real verification. So people think that they're ready until they're not. Step 2, it's shopping. And this is where emotion kicks in. When you work with me, the pre-approval is a fully underwritten pre-approval, so you're pre-qualified for the number that I tell you. And then when you're actively shopping, I'm gonna show you what the purchase of that said property will actually cost you down to the dollar per month. But what I see people do is stretch their budget, push their limits, and try to make the numbers work instead of asking, does this actually fit my life? Step 3, it's structuring the mortgage, and this is where I come in, and this is the part that almost nobody understands because they're focused on a low rate. You hear people talk at the water cooler at work that, oh, what rate did you get on your 5-year fix? And they're comparing their 3.99 to the 3.89. And then you have that one quiet person who took a 4.34 because of the flexibility behind it. Step 4, it's closing. Everything gets signed, but what I often see clients working with the bank is they're blindsided by closing costs. My clients know to the dollar what they're gonna need to bring to the lawyer or notary. Then once everything's signed, they're locked in, and that's it. Now you're gonna live with that decision for years, 25 to 30. Here's the shift that I want you to make. Stop thinking about your mortgage as a monthly payment and start thinking about it as a system, because the way it's built, it's gonna determine how you move financially. Most Canadians will spend decades in a mortgage without ever realizing that they had options. Those options could have saved them tons of money if structured differently, that they could have built more flexibility in and saved more interest. They could have moved faster. You don't have a mortgage problem, you have a strategy problem. If you want help designing this properly from day one, there's a link below where you can book a no strings attached call with me, and I'll walk you through your numbers and build something that actually works for your life, not just today, but 5 years from now, 10 years, and 25 years from now. And when you're done with this one, go watch last week's video where I break down the current interest rate market today. See you there.